morning and welcome to Bloomberg Quint, India's first live digital streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Good morning, Neeraj.
Good morning, Neeraj. Very good morning to all of you. Let's get straight down to the headlines this Wednesday morning. The RBI Monetary Policy Committee may choose to stay put on key interest rates, shows a Bloomberg poll of 46 economists. Base metals post their biggest drop in 2 months. Copper leads the declines on the back of a stronger dollar and concerns over falling demand in China. One of India's largest funds, Life Insurance Corporation of India, says it is going to press the pause button after investing 44,000 crore in equities this year. And Future Supply Chain is looking to raise 650 crore from the primary markets. The IPO opens for subscription today.
Well, let's take a quick check as the trade setup for the day. Now, remember, the big talking point, of course, for the markets today is what's happening to the commodity pack. And commodities across the board have fallen. And essentially, the hard commodities have come off really, really strongly. So look at copper, nickel, aluminum, all of these have come off. Now, here are some trends. First time since June, that's the key thing. The fact that they are below the 200-day moving average is fine. But it's the first time since June end that we're having gold sub 200-day moving average, copper sub 100-day moving average, nickel sub 100-day moving average. July for nickel, quite frankly. But it's essentially the past 4 or 5 months that these commodities have stayed above these key moving averages and are coming off. This is the second large correction that we've seen in commodities in the last couple of weeks. So anywhere between 5 to 8% to 10% from the highs is what's happened to the commodity pack. Will this have an impact on equities? Well, specific pockets, yes. Does it have an effect on risk appetite? I think we'll get in an expert talk about all of that and more. But keep in mind, these are the key trading points for today's session. But what about equity markets? It's been a mixed opening for equity markets across the Asian bourses. You would probably see more ticks of red than green. There's SGX Nifty 2 indicating that bit of red in the session today, and the index has been doing that. You know, the last 5 trading sessions now, we've had a lower high and a lower low. That doesn't augur quite well. Let's see if the markets manages to change that. Difficult to say whether it does that on policy day or otherwise, but that is something that the index needs to reverse for some bit of confidence to come in. The Nifty Bank, though, showed some signs of that. It's been showing signs of pullback at lower levels. Yesterday too, it was the Nifty Bank that led the index slightly higher. Key PSU banking names, SBI, PNB, Canara Bank, all of them ending the day marginally in the green, and the Nifty Bank itself showed a pullback of almost 300 points from the lows to the highs in trade yesterday. So that showed some bit of buying interest that came into the banks in trade. Difficult to say whether this will last ahead of the policy or no, but this is something that you need to watch out for. And I think Reliance needs to be closely monitored. Yesterday we were talking about how it's bouncing off the 50-day moving averages. Look at that chart, and those 4 circles that I've drawn on the charts indicate how Reliance at each time when it's nudged that 50-day moving average has consistently bounced back. Yesterday that was the big mover in trade. Let's see if that continues to hold out and give that little bit of support to the markets or no. But this is a very interesting observation that we saw on the terminal. Stocks to watch, a clutch of them. I just marked 2 or 3. There'll also be the Birla Capital and some results that we'll watch out for. But I think Dish TV, soft quarter. I thought brokerages, the verdict that came out, maintained a buy, CLSA in particular. So interesting to see that. Bharat Financial, RBI will announce further buying in shares of Bharat Financial. So that is something that you want to watch out for. And a clutch of other mid caps and small caps, noticeably the sugar names and Praj Industries, all of which bounced off substantially in trade yesterday. Let's see if that rally continues today.
Right, just a quick word coming in from one of the largest investors in Indian equities, LIC. Not really raising a direct concern on valuations, but sort of signaling that they see markets being toppish right now. So I think VK Sharma, the chairman of LIC, was out in public yesterday, and he talked about the fact that they've done about 44,000 crore in terms of equity buying for the year. But they may not go too aggressive. Now, remember, LIC has to invest a part of their money in equities depending on which of their schemes get in money. So it's not like they can be very choosy about where they invest, but in terms of incremental investing beyond that minimum amount, they do have some choice. So VK Sharma said the market is at its peak. We will keep on doing routine sales and purchases of equities, but we will not be aggressive in buying equities. They always sort of buy low, sell high. That's LIC.
Yeah, and interesting. He made a plea to RBI. I thought, if I'm not wrong in that story, that give us longer yielding GSECs because we want to invest in bonds. I think it's something like that.
Yeah, that was an interesting one as well. I think that's been a long standing demand to some of the insurers because they want long securities to invest in. We don't have enough of those.
Okay, interesting. But that's LIC, yes. They put in large chunks of money, but maybe not too aggressive going ahead for the next 3 or 4 months. But as we said, before we get into first word, I think what's important is to address the commodity markets. LME base metals index saw the worst decline in over 2 months. Both copper and nickel fell more than 4% apiece. Even in Shanghai, base metals are down naturally, so 1 to 3%. To talk about all of this and more, David Lennox, resource analyst at Fat Profits, joins us from Sydney. David, good morning. Thanks so much for joining in. Now, this is twice in the last 2 weeks. I think November 28th or 29th was one large fall. Yesterday has been one large fall as well. What's happening here? Are these signs of commodities topping out for the near term or the intermediate term?
Oh, good morning. Certainly, if you have a look at 2017, we've had a very busy year when it has come to commodity prices, and quite a good one. So one would expect, as perhaps we're getting towards the end of the year now, that we would see some profit taking across some of the commodities, and we do believe that that's what we saw happen overnight. There was some build in copper inventories, and there has been some concern over various countries and their rates of growth going into 2018. And with that, we just saw both really copper and nickel really let go overnight. That would suggest to us that perhaps, yes, we are seeing a little bit of a toppish move in the commodity prices as we go into the end of the year, but certainly we don't expect to see any great depth in any decline in the prices going forward.
You mentioned profit booking. Copper is down about 8% or 8.5% from the August highs. Now, would you believe that this is the extent of profit booking, or do you think there could be more?
We certainly think that, yes, there will be volatility as we get through to the end of 2017. But we think once we get beyond this year and look into 2018 and start trading in 2018, that the outlook for the commodity sector does look a lot brighter. We are now in the, let's say, northern part of the northern hemisphere winter, and that is the slow season for commodities in general. So we would expect to see that type of volatility. When we move through the summer and when we move through the winter and come into the northern summer, then we'd expect to see some return of stronger prices for the broader base metals.
Last question, David, from my end. Gold too has corrected, I think, sub the 200-day moving average for the first time since June. Any thoughts there?
Yeah, look, you'd have to suggest that the same factors that probably impacted on the nickel and copper prices, and especially the US dollar, has driven the gold price lower. The other thing is we're starting to see, I guess, some complacency towards some of the geopolitical events that were driving the safe haven aspect of gold and pushing the price up. Some of those geopolitical events are now starting to drag on in terms of time, and we've seen no change in terms of their intensity. So that would suggest that the premium for risk has started to come out of the gold price, as well as we do believe also some booking of profits. And that would see the gold price, as we saw overnight, like with nickel and copper, give up some ground.
Okay, David, we'll leave it at that. Thanks so much for taking the time out early morning and talking to us. That's David Lennox. Believes this is routine profit booking. May last for the month of December, but expects some buying to resume in the new calendar year.
Well, I would have told you that if you'd asked me. Here's what we have for you on First Word this morning. Of course, we're talking RBI monetary policy, specifically why economists don't expect the 6-member MPC or Monetary Policy Committee to cut key rates today. We'll also talk about Kotak Institutional Equities outlook on cement companies. It continues to be cautious. We've seen declines in prices, especially in the southern part of India. Sugar companies may be in a sweet spot now that the government is unlikely to extend stock limits beyond the year 2017. And this morning, we're throwing in some geopolitics as well. The US may get set to recognize Israel, Jerusalem as the capital of Israel. We'll talk about the implications of that move. But let's kick it off with the most important event of the day, if not the month, and that is the Monetary Policy Committee's big decision on interest rates. And the last I read, it was like 42 or 48 economists in a Bloomberg poll say no change. A sad lot of 8 say maybe down to 5.75% era.
healthy dose of sarcasm there early morning. Yes, it may be an expected decision, but it is monetary policy, so we will bring you what we call the comprehensive guide to the monetary policy decision. You've got an expectation that you would have most of the MPC members vote in favor of a pause. So 41 or 46 economists said that there will be a pause in rates. A few said that there will be perhaps another 25 basis point cut in rates. The questions here to debate are the ones that we have talked about through the last few months, and growth, of course. Since we have a new GDP number at play on growth, we will talk a little bit more about growth, and the MPC will debate it as well. The question there is going to be whether the growth number is strong enough, or the growth rebound is strong enough. At 6.1%, it was a middling kind of number that we got on GVA growth, and within that there was a lot of confusion about what's moving that growth number. Some focused on core GVA and said that that's strong, and hence private enterprises recovering. Others focused on consumption and said that consumption growth is weak, so maybe the economy is not recovering. Manufacturing was a question mark as well. So there's just too many interpretations. MPC's interpretation will probably be important, and if they do judge that the output gap, the negative output gap, is widening, maybe there could be a case to be made for another interest rate cut. On the other hand, inflation is more or less along the lines that the MPC has been expecting. So they had said it would be about 4.2% in the third quarter and 4.6% in the fourth quarter. You are somewhere a little bit close to that, but still below it. Core inflation, of course, remains the big question, and risks going into next year. Oil, metals, fiscal slippage, all of those risks will perhaps keep some of the more hawkish members of the MPC away from recommending a rate cut. And here I just want to quickly mention that the MPC actually tied its hands, or at least the RBI tied its hands last time when they said that 50 basis points of fiscal slippage in the current year will add 25 basis points to the headline projection on inflation. Having put that view out there, it'll be very tough for them to now say that we are going to cut rates because we think X, Y, Z. They're not. It's just a really tough rollback to do after putting that exact number out there. The focus for the bond markets will be on liquidity. We have been talking about bond yields going up. About 706 is where they settled yesterday, but they've taken out even 710. This is despite the fact that you got at least one rating upgrade, and despite the fact that the RBI cancelled an open market operation sale. So all of that keeping in mind, the RBI will also perhaps want to calm the market. Some of the bond traders are saying that they've been getting calls from the RBI asking what's really bothering the market. So maybe watch out for that in particular. Bond yields are up about 60 basis points since October. 40 basis points since October, 60 basis points since the start of the year. And also, if you look at the difference between the repo rate and the 10-year yield, it's more than 100 basis points. There's nothing sacrosanct about the 100 basis point number, but typically one would say that when you're still accommodative, you're still neutral, at least in your policy, 100 basis points is a fairly steep sort of curve from the overnight rate into the 10-year yield. So watch out for answers on liquidity. Lots of questions out there. Hopefully, if we get a chance, we'll put at least one of those questions. Will OMO sales continue? Has the RBI done with OMO sales for the year? Is the RBI comfortable if additional borrowing from the government comes in the Jan to March quarter that the market will be able to support it? Does the RBI then say that if additional borrowing comes, we are committed to maintaining comfortable liquidity conditions? All of those questions will be out there, which will be in focus. And those are the questions which may move the market, unless, of course, you get a surprise rate cut, in which case, we'll...
I love how you've left room for that. No more OMO bond sales. That's the kind of commitment that the market's looking for from the RBI. So if we don't get anything as committal as that, will that hurt bond yields?
No, so I don't think they'll say it in those many words. They never do. But, in the press conference, you will get some, indication of what their stance towards OMO bond sales is. There'll be a whole bunch of questions, I'm sure, put to them on that. So anything that indicates that they are more or less done with the OMO bond sales, or anything that indicates that we are committed to maintaining comfortable liquidity, situations, anything that says that we are committed to supporting the government borrowing program, any words which are nuanced towards the understanding that liquidity situations have turned, will be comfortable enough. If they go to an extreme and say that we are committed, which they won't, but if they say that we will endeavor to maintain liquidity at 1% of NDTL, which is about 1 lakh crore or so, markets will like that. I don't know that they will say that. They very, very rarely do. But if they say something that suggests that they are not as uncomfortable with liquidity as the market is, then bond yields could go up further. I don't think they will, because a lot of bond traders are saying that the RBI has been wondering why yields have sustained above 7 and even moved towards 710. So I think they are not hugely comfortable with the levels at which we're trading on the 10-year yield.
Expecting commentary on the fiscal deficit, etc. And can I put in a little GST agenda point here? Look, are we going to get any idea from RBI on how they assess government revenue?
You won't get a number from the RBI for sure. They will not get into that. I think last MPC, they had already brought up the risk of fiscal slippage, which is why they put that box item in the monetary report, which said that if there's a 50 basis point slippage on the fiscal this year, you would add to 25 basis points on the baseline projection on inflation. Hugely debated forecast. They got a lot of criticism for that. But, that is the number that they had put out there. And if you look at the MPC minutes, even Urjit Patel, so if you, talk about the governor as the first among equals, even he had sort of talked about the fact that fiscal slippage is a risk. So I think they're well aware of that. I don't know that they would preempt the government's, announcement on increased borrowings, which is quite likely according to the market in the Jan to March quarter. But I'm sure if there are questions put to them on fiscal, they will talk about it in their statement. They will certainly talk about fiscal as one of the risks to the inflation trajectory. You get one now in February, and that will be the last.
That'll be after the budget,
right?
Yes. That'll be the
after the budget.
So is this technically the last opportunity they really have to cut rates, if at all they are inclined to do so, or is it something that they might find more comfortable to do so in Feb, once they've had a clear idea or a clearer idea of the government's finances?
I think then you will run into the problem of how inflation is playing out. So, right now headline inflation is still below 4%. So if they really had to argue, you could argue on basis of growth is not picking up as much, inflation is still whatever. When you get into next year, inflation is expected to be between 4 and 4.5. At least that's what the RBI's projections for Q4 are. And if you are in that 4 to 4.5 band where you've already taken out the midpoint of your forecast, very tough to then argue that, okay, despite all this headline inflation number, because we are comfortable on the fisc, we are going to cut rates. So actually a lot of economists, like for instance, Indranil Sengupta at Bank of America Merrill Lynch, who've been arguing for one more rate cut, have said that the window is slowly slipping away. They thought that December was this last window. And we haven't talked much about the Fed, but the fact that the Fed will continue tightening will be somewhere at the back of their minds as well.
It's up next week. 12th, 13th is the Federal Reserve's last policy meeting, and I think it possibly is also Janet Yellen's last policy meeting of the year, and not just of the year for her tenure as well. So, and they're expected to hike rates then as well. That's the consensus building up that the December rate hike will happen. So, all right, my monetary policy bit is done. So,
no, that's
but for the rest of you, please tune in at 2 o'clock this afternoon, and 2:30 we'll be at the Reserve Bank of India and bringing you all the analysis live as we find out from the MPC on what they've decided to do.
Yeah, it'll be interesting. So full coverage at 2, and yes, the statement out at 2:30. So you need to be tuned to Bloomberg Quint for that as well. But that's about the chat for the monetary policy right now. But remember, at 9:30, we'll have a discussion with a banker on what the policy and the details might be. So you want to probably stay tuned for that as well. Moving on from the policy to specific sectors, commodity linked. Firstly, cement. There might be another year of earnings downgrades coming in for the cement sector. That's according to a recent report by Kotak Institutional Equities. A weak demand environment can keep prices subdued, while the ban of pet coke in 3 states can increase cost pressures for the industry. This is much spoken about. The question mark is what kind of impact could it have, and what has Kotak analyzed it as? Darshan is standing by with the key takeaways from the report. Darshan, how much of a hit is Kotak pricing in?
See, they're expecting it to be a weak quarter going ahead for cement, but it's an interesting report in which basically they talk about the pricing trends that are there as far as the cement sector is concerned. So this is all India average rupee per bag. It will be a 50 kg bag. So what they've said is that there has been a continuous increase, and then for the next 6 months there was this decrease, and finally after 6 months of decline, finally we are seeing an increase of 4 rupees per bag in December. So these are the trends that they have spotted as far as the entire cement sector is concerned. They break it down into where they see the price trend, and majority has come in as far as the north is concerned, because the problem of pet coke has happened there, wherein 3 states have been banned to use pet coke as raw material. So that is where maximum price change has happened. So 16 rupees is the increase over last month. Central has seen an increase. It's been rather flat as far as east and south is concerned, and west in fact has seen a decline of prices. So prices currently are most expensive in east and south. south, but the price increase recently has happened maximum in the northern area. So this is an all India trend that Kotak has actually spoken about. Now, individually, we'll speak about some of the trends and some of the content that they are speaking about. First of all, what is weighing in on cement prices and cement companies? The petcoke ban usage in 3 states, and that is where you saw that North actually came out with a big price hike. Cost prices are rising, cost pressures are rising as per Kotak. And finally, what you're also seeing is that demand environment continues to remain weak. So on all fronts, some of the cement companies are getting, attacked from all fronts. Now, if you're looking at North, basically Delhi and Haryana is where the maximum increase happened. 25 rupees per bag is the increase that happened, and in Haryana it was 20 rupees, Punjab and Rajasthan. So all these areas are where the petcoke ban still remains. So these are the areas wherein price hike had actually happened. Price hike largely also offset the fuel cost inflation that was there. That is as per the Kotak report that happened. Basically, let's move on to the west. Maharashtra and Gujarat, both of them saw a decline of anywhere between 3 rupees to 2 rupees per bag. And as far as the south is concerned, Kerala was the only one which saw a 10 rupee increase in bag. The other states were rather flat. And finally, moving on to the other geographies, as far as south is concerned, the sand mining issue is clearly there. We wrote a story about it yesterday, and the weak demand is clearly there as far as the southern market is concerned. Now, this is the eastern market. In the northeast and Orissa, there have been a price decline of 10 rupees and 5 rupees. In Bihar and West Bengal, there have been increase of 5 rupees per bag. So this is an all India scenario that Kotak has actually panned out. What are the concerns for the cement sector? First of all, subdued demand. GST and GST had dragged prices since May. So from May, you're seeing that prices have continuously been falling, and this is the only month which you saw an increase. They expect earnings downgrade in FY18 to continue on rising cost that is there. And large cap valuations are rich despite optimistic earning expectations. So they're not too optimistic as far as the large caps are concerned. They would rather prefer the mid caps. And the counter that they like at this point of time, Grasim, no longer, it's still a large cap, but among the counters that they like, Grasim, JK Lakshmi Cement and Dalmia Bharat are the counters that Kotak prefers at this point of time.
Yeah, it's interesting. If you look at some of the top, the key cement companies, stocks haven't done very well in the last month or so. Though I think year to date, they've kept pace with the Sensex or maybe even marginally outperformed the Sensex. Yeah. But look at ACC, look at Ultratech, and I think we've seen almost 5 to 6% losses on those couple of stocks over the last month or so, far worse than how the Sensex has fared, at least in the month so far. So.
Yeah, you would expect that maybe post-monsoon demand could actually improve for cement firms, but that's not been the case this time around. Some price erosion as well. The question mark is, can real estate and infrastructure kickstart the much spoken about recovery in a hurry? And if that happens, then maybe there is some solace. But otherwise, yeah, the last 1.5 months post-monsoon haven't been particularly great for
this is classic micro indicator telling you what is happening at the macro level, right? Yes. I mean, if things were actually strong or getting stronger, why would cement not pick up in terms of volumes? At least I can understand, various other pulls and pressures.
Yeah, I'm not sure this is as much a commentary, though, Ira, on volumes as it is on pricing strength for these companies, given, I think both the petcoke ban, what that means for input costs, sure. And, I think the sand mining issue is a demand issue, because that hurts the real estate industry and therefore it hurts cement demand in that sense. Yeah,
completely. But in terms of just strength of demand and the ability.
Absolutely. Nowhere close to the kind of recovery we had expected when you look at the prices that Darshan was showing on that chart. The peaks that we saw I think in May, June of about $349, $350 per 50 kg bag. I think we've come off quite a bit since then, 323, 325. Yeah. That was not what we had expected for the month of December, for sure.
No, for sure not. Well, but let's wait and watch. And I think at some point of time over the course of the next 1 or 2 sessions, we'll also have a chat with one of the cement companies to try and figure out what is the near term looking like. I tell you what, though, sticking to commodities, and it's a small pocket, but just very briefly mention this because there's a big spurt in prices in some of the sugar counters in trade yesterday. One would have thought that maybe ethanol had something to do with it because there's much talk about ethanol prices moving up, but it actually had to do with sugar. Now, this is not official as yet, but sugar companies that we spoke to on condition of anonymity mention. And there was some mention in a couple of media places as well about there being an in-principle decision taken by the Food Ministry to not extend the stock limits for sugar beyond December 31st. Remember, there are limits in place right now, and those limits might be pulled off. Now, why has this come about? Remember, sugar to an extent plays a part in inflation. Used to be a fairly heavy weight, now maybe not as much. But sugar prices from the peak that we saw, or I'm using the term peak relatively for the year, calendar year, sugar prices have come off quite dramatically. I think June or July was when we saw prices at its peak for the calendar. And if we get the chart up, you will see that the last 4 or 5 months there has been a steady decline. And since October, sugar prices have come off by about 8 or 9%. So the concern on sugar prices staying high and affecting the Aam Aadmi have probably come off. So much so that now, for a lot, this is the price chart for sugar, and so much so that now for a bunch of companies, even despite the lower SAP for UP or otherwise, the cost of production is steadfastly higher, and the lower sugar prices doesn't help causes. Now here's the sugar math, guys, and this is all estimates, so you'll have to excuse me for that, but this is all estimates. So opening balance estimated at about 4 million tons, sugar production standard at about 25 million tons, and domestic consumption at about 25 million tons. With the imports still being on, you probably expect about 2.5 million tons, but because I don't have an exact handle on that, I haven't quite mentioned it. But what does this show is that the concern of demand outstripping production is not true. And there is a healthy opening stock of 4 million tons that we have, which is at par with what we've had for the last few years as well. So demand scenario, demand supply mismatch, not there. Prices have come off. Is there a reason for keeping these limits in place? Probably not. The industry has been demanding it for a really long time. And now we may first see the signs of this going away. There are other triggers. There's talk of import duty on sugar likely to be raised. SAP, we all know in Uttar Pradesh has come off as well. So there's some positive triggers. Maybe the stock prices which have come off in the recent past are clutching into all of these and starting to move up a bit. I dare say, even if this turns out to be true, it's probably a rally for a day or two, not too much beyond that.
All right, guys, I'm going to throw some geopolitics in the mix this morning, and the only reason I mention it is because this is incredibly important for the Middle East, and this announcement potentially by US President Donald Trump could heighten tensions in the Middle East. There is talk that he may recognize Jerusalem as the capital of Israel, and I'll give you some very quick background to this. So the US Congress passed a law in 1995 requiring that the embassy be moved from Tel Aviv to Jerusalem, but it also included a waiver in that saying that you can delay that move by 6 months, and US presidents have been using that waiver ever since to keep delaying the move. In fact, just as recently as June this year, President Trump did exactly the same thing, which is delay the move by 6 months. Now, it has been the campaign promise of Donald Trump, and not just him, of a couple of presidents before that as well, to recognize Jerusalem as the capital of Israel. Israel right now believes that Jerusalem is its rightful capital, but the rest of the world does not recognize it as that. It recognizes it as disputed territory, to put things in very, very simple terms. News reports yesterday suggested that President Donald Trump had in fact phoned both Mahmoud Abbas, the president of the Palestinian Authority, and Jordan's King Abdullah to inform them that he is going to likely make the decision to move the embassy to Jerusalem, or at least recognize Jerusalem as the capital of Israel. Bloomberg, though, is quoting a source to say that he may opt for that waiver clause yet again. So this is not yet a done deal, but if it were to happen, it could heighten tensions in the Middle East. We've already seen warnings come in from Europe, from Middle Eastern leaders, saying this is not a good idea. It could disturb the peace process to whatever extent that's been progressing, and that could hurt the region and produce more unrest. In fact, just ahead of the president's decision, the US's consulate in Jerusalem has barred government employees and their families from personal travel in the Old City and the West Bank. This is according to a Twitter post that Bloomberg was quoting. And the State Department earlier in the week had sent alerts to embassies and consulates in Muslim-majority countries warning about possible unrest linked to a presidential announcement. So even the US is cognizant of the fact that this may hurt its interests across the world in an effort to foster peace in the region. But this is local politics politics playing out, on the international playing field, so to speak. We will know later tonight if this were to become a reality. And if it were to become a reality, then I think that the reaction from the rest of the world, especially from Muslim nations, is going to be a very, very tough one. Jerusalem, as you know, is the seat of 3 major religions in the world, Judaism, Christianity, and Islam. And this is going to be a tricky one to navigate, an important decision to watch out for, and it could be one of the most important geopolitical things we go into 2018 with, if that decision does come in from President Trump tonight.
Well, important things to watch out for. So lots to watch out for from the monetary policy to some international news flow as well. But that's all the commentary that the 3 editors have for now. We call it a day on First Word for the time being. But remember, a bit later on in the show, we've lined up a chat with Dhananjay Sinha of Emkay Global, who will also talk about the dealer conference that they have to get an on-ground view. We will talk to him about what's happening within the cement space as well. Monetary policy expectations from Manish Wadhawan of HSBC India, and business outlook with KRChoksey of Apex Frozen Foods. The stock refuses to go down. We'll talk to the management as to what's happening on the business front.
Newsflash, Bitcoin's at 12,000.
Yeah.
And finally, the RBI woke up and put in a cautionary
warning
note.
Out yesterday, right?
Yes, reiterated their previous warning.
Neera's calm nerve, afraid nerve, saying, what are they saying anything
exactly.
about it?
I was all set to ask a question. My one question I would have wasted on Bitcoin.
On Bitcoin? You're kidding me.
It was a toss-up between the government dividend to RBI dividend to the government, divergence in bank reporting, bank bad loan reporting, and Bitcoin. I was tossing up between those 3.
I can't believe Bitcoin was even on the list. But anyways, yeah, the RBI said it's a bad idea, to put it in like very simple colloquial terms. But sorry, Neeraj, we'll let you get on with the derivative space.
No, well, about time. So let's get in, Navneet, to talk about what's happening with the FNO setup for the day. Navneet, good morning.
Good morning, Neeraj. Well, the markets will be taking cues from the RBI monetary policy, as you guys have been discussing. SGX Nifty this morning, however, is showing a downtick of about 30 points. Let's look at the cues then. Where are we getting? Nifty futures yesterday closed with premium of 28 points, and we did see some bit of positions being built up as the open interest was up nearly 6%. Let's just pull up Bank Nifty, which will be in focus, and we did see some bit of outperformance from Bank Nifty in yesterday's session. As you can see, it closed with premium of almost 100 points, and the open interest also surged nearly 3 points. But most importantly, your India Volatility Index, that's been a cause of concern. It closed above the mark of 15, first time since August 11, 2017. And a lot of the analysts are saying VIX has to recede to levels of 12.5 for any sort of recovery to be seen on markets. Let's look at the most active strikes then in yesterday's session. But before that, I just want to show you the trend in the Nifty futures premium. We started the series with 52 points. Look at that, how it's been coming down. This is actually telling you that there are short positions being taken whenever there is any sort of pullback seen in the markets. With that, let's also look at the active option strikes. The call writing is actually continuing on strikes like 10,100 and 10,200, but the base for this market is actually shifting lower. The 9,900 put yesterday became active. That added nearly 6 lakh shares. But remember, the range still remains between 10,000 to about 10,500, and 10,000 is a very crucial support for Nifty. What are the FIs doing then? Well, they are building up their short positions just ahead of the RBI policy. 21,000 contracts added on the index futures front, and even the options data will throw up the same thing for you. Though they added little bit of call longs, but there was a lot of writing seen on the call short side, which is telling you that they are hedging their cash portfolios in the options data. Just 2 stocks before I wrap. Balkrishna was pretty active in a weak market, or rather a volatile market. Look at that, open interest up nearly 35%, telling you there's a lot of long positions being built up here. And Hexaware is the stock that we've been talking about in the last few sessions. Yesterday also, the stock was quite active, up 3%. On the future side, we saw some long positions being built up. Back to you.
Thanks a lot for that, Navneet. We'll watch out for these 2 interesting names. Keep in mind, we've been talking with Navneet about how there are no stocks in the FNO band at the start of this new series, a marked departure from what we've seen in the recent past. But Abhijit Phatak joins in to talk about his thoughts on the FNO space. Abhijit, thanks so much for waiting by Abhijit. Apologies coming to you a bit late, but just a quick thought on what the indices are showing, because the Nifty Bank is probably showing a slightly divergent trend to how the Nifty has been starting the last few days.
Good morning, Neeraj. Yes, there were some signs of bottoming out yesterday, and like I've been saying, it's a bit risky to go short at these levels. and that might be coming true. Of course, the trigger is the RBI policy, but Bank Nifty showed some strength, and if that continues today, the trigger for Nifty on the technical side will be a close above 10,180 on the spot. So unless that is crossed and it closes above that, taking longs overnight will be a bit risky, but above that it should be clear for the rally.
Okay, so would you take a position, options or otherwise, into any of the indices ahead of the policy, Abhijit?
Yes, there is no harm in taking a small position on a 10,300 call, which went from 58 to something like 83 yesterday. So if it comes back towards 60, which it might, because SGX is again trading to near 10,100. So any dip on the 10,300 call near 60, 65 with a stop loss of 45, one can go long, and then if it closes above 10,180, that position can be carried.
Okay, and lastly, your stock recommendation for the day, Abhijit?
Yeah, yesterday Bharat Electronics BEL showed some strength, and there was a good support near 175, 177. So today again, if it dips towards 178, 179, it can be bought on the futures, and with the stop loss below 176. I think it can go towards 183 or 185, and I'm expecting even 190 sometime in December.
Great. We'll watch out for this. Thanks a lot for that, Abhijit. Phatak, appreciate you being with us today. Moving on, and the commodities are the biggest talking point. We've spoken earlier with David Lennox as well. Pradeep would have his own analysis too. He joins in with that and to take the show forward. Pradeep, good morning.
Good morning, Neeraj. Well, if you look at it, the LME base metal has had worst day probably in last 10 weeks or so. If you look at, after September 27, this was the worst decline that we have seen. Copper and nickel both falling more than 4%. Copper has fallen, or the base metal in general have fallen not only because the dollar has gained against other currencies and dollar index is inching up towards 93.5. It's also because the Chinese Kaizen PMI data that came in earlier were also soft, and looks like the China that accounts for roughly half the demand for all these key metals, the Chinese demand is not really picking up, and that is actually taking its toll on metal prices. If you look at the Shanghai trade this morning, most of the base metals are down between 1 and 3%. To talk about precious metal, the picture is no better. In fact, dollar is weighing heavily on precious metal. If you look at gold, it dropped to 2 months low. If you look at silver, it's trading around 4.5 months low. Platinum is trading around 2.5 months low. And this is mainly because dollar has gained on the back of quick action that US Congress has taken. The House of Representatives have in fact already passed a resolution that would kind of start the process of negotiations with the Senate, and they'll come out with a combined draft for the tax reform. And these tax reforms are positive for dollar, not so positive for other currencies, not so positive for commodities also. Well, if you look at oil, that one has also dipped a bit. US gasoline build has kind of surprised, and the gasoline stock has risen surprisingly. That was not really expected, and that is the reason why oil is also down. So all the commodities, even if you look at rubber, it's also down by around 2.5% when I checked last. So the cues for commodities is all negative.
Well, the markets, equity markets too, likely to start off on a negative note. Nikkei is showing a downtick of about 1%. Nifty, or SGX Nifty, about 0.5%. Gaurang, Shah, head market strategist at Geojit Financial Services, joins us on the show. Gaurang, cues for today slightly negative ahead of the policy. Would it pay to stay light?
Hi, Neeraj. Morning to all of you all. Well, I think it's going to be a knee-jerk reaction, and according to what my networking tells me, large part of the market participants believe that there is going to be a status quo, no rate change. Commentary from the Honorable RBI Governor will be something that would be interesting. And of course, the outlook on the Indian economy, world economy, and of course, the numbers as far as the GDP growth rate is concerned and inflation is concerned. So more than a formal knee-jerk reaction, I don't think there's going to be any significant impact on the market, either on the upside or downside.
Okay, so you don't really expect the policy to kind of alter the trend in markets. What are you really advising your clients? Are you suggesting selective buying on declines, or are you cautious and hedging?
Well, I don't think cautious is the stance that we have any point of time, Pradeep. We've been always advising to be selective, buy on dips is the strategy that we have always recommended, and that happens to be the strategy that we have laid out at least for the next week or two. And as you know, after credit policy, you will have the voting in the state of Gujarat from 9th of December, if I'm not mistaken, and 18th December, Monday, will be the most interesting day in terms of which way the election goes, which way the mandate goes as far as the state of Gujarat is concerned. That will be the day, I think, you will see a decisive move on the markets, depending upon which party is likely to be elected in the state of Gujarat. I think till such time, Pradeep, there is going to be a very range-bound move on the markets. Index, I'm talking about Sensex and Nifty. But like we've seen over the last 2 or 3 days, when the market does not do much, you have stock-specific news flows and a reaction coming. So it's more going to be a stock-specific approach towards the market. Like I mentioned, we've been advising to buy on dips. And the sectors that we've been advising, Pradeep, is consumption-related, FMCG, consumer durable, consumer discretionary, selective names in the banking, public as well as private, NBFCs, metals, cement, auto ancillary. That's the broad theme that.
Okay, so these are the sectors, and which are the key stocks that are likely to remain in focus today due to the results or any other news developments, or maybe research report coming from a leading research house. Let's go across to our research team and talk about it. To begin with, Saloni will talk about Dish TV. The numbers are not really interesting, but if you look at the research reports, 4 reports that I have seen, 3 have upgraded. Why is it?
So Dish TV numbers actually came in line with analyst estimates. So operating revenues were down 4% at 750 crore versus 780 crore seen last year, while the company reported a net loss of 16 crore versus a net profit of 17 crore seen in the same quarter last year, while EBITDA margins came in lower at 28.9% as compared to 34%. However, on a sequential basis, it did improve marginally by 150 basis points. Elsewhere, Dish TV added 188,000 net subscribers this month and were in line considering the seasonality of second quarter, while subscription revenue grew 2% sequentially and it stood around 705 crore, and also their average revenue per unit, that is ARPU, was almost flat at 149 rupees. Now talking about their merger plans with Videocon D2H, management expects last leg of approval from Ministry of Information and Board anytime soon, and they are quite optimistic about their merger, and they have guided a synergy creation of approximately 180 crore in FY18 and also 510 crore for FY19. Now, brokerage houses like Nomura, CLSA, BNK as well as HDFC Securities maintains buy rating on the stock and have raised the target price in the range of 3 to 11%. The exception being HDFC Securities, wherein they have actually cut their target price marginally to 102 rupees from 105 earlier. Now, all these brokerages are quite bullish on Dish TV's merger plan with Videocon D2H, and also they expect ARPU to improve in Q3 and Q4 given GST benefits realization for this company, Pradeep.
Okay, so brokerages remain optimistic. Shraddha, what other stocks are you watching for?
Well, to start off with Bharat Financial, where the RBI has relaxed the limit for foreign investments, we could see some positive reaction there, but it might not be that good a day for Shilpa Medicare because they've received 10 observations from the US FDA under Form 483, and this is for their Telangana plant, so some negative reaction there could be expected. You have a Mint report which is saying that Lanco Infra is looking to sell for renewable energy assets, and you also have a Times of India report which says that Asian Development Bank has cleared loans worth 583 million for Reliance Power's Bangla project, so keep an eye out on that name. Aurobindo Pharma, drug approval coming in from the US FDA. This is for ranolazine, which is used in the treatment of angina. And lastly, you have Dalmia Bharat, which ET report says has now joined hands with Piramal Bain Fund to bid for debt-laden Binani Cement. So Dalmia Bharat and Binani Cement, this news bid could keep those two stocks active as well.
Okay, Nikki, you are looking at some more earnings.
Yeah, of the bunch of earnings that came previously, only one earning precisely stood out. That's Windsor Machines that we're looking at. A decent set of performance coming in from the company. Revenue was up 8%, net profit up 30% year-on-year basis. EBITDA rose 18% and margins expanded for that matter. Cost saving and higher sales led to good operating performance of the company, along with your other income also aided the bottom line performance. Second on our list is Lux Industries. Not a good set of numbers, lower revenue and higher spend spend towards your employee expenses and other expenses is what has led to a dip in operating performance, which has come down by 17% on year-on-year basis this quarter. Also, if you look at Manali Petrochemicals, not a good show there itself. Again, a bad set of numbers. Net profit has come down by 16%, EBITDA for that matter 26%. So muted sales and higher sales and dip in other income has led to a disappointing show from Manali Petrochemicals. Other bad set of numbers that we have on our list is Plastic Blends, Harrison's and the Bike Hospitalities. These are the three companies which have not reported a good show. Net, just one company that has managed to give a good show in the September quarter out of the bunch that we tracked.
Well, thanks Nikki, Saloni and Shraddha for this update. There are plenty of stocks to talk about, but Gaurang, Dish TV, the reports that Saloni just talked about, they indicate an upside of 20 to 30% from current level. Do you also advise a buy?
Well, Pradeep, we have been maintaining a buy coverage on Dish TV from 45, 50 odd levels. We continue to maintain that with a target of about 115, 120. Really excited about the entire digitization process that has been laid out by the government and the success that it has achieved. And this is one of the largest direct-to-home service provider, Pradeep. And according to our estimates, I think out of 10, 6 or 7 dish antennas are of Dish TV. Earlier, the ad spend hangover was creating a concern on the margin front. That has come down substantially, and we believe that the new product in form of HD set-top box has found tremendous amount of traction amongst the consumers, subscribers. Rates have got revised upwards, and as the entire digitization process rolls out pan-India, our sense is that the HD set-top box is going to be one which will garner a large part of the market share and give help in realizations of revenues. We remain positive. Only thing is your time horizon needs to be at least a year and a half plus to achieve those targets of about 115, 120 that you set aside.
Okay, Gaurang, stay on. So much more to talk about. 8:45. Let's shift focus full tilt to the derivative space and in the technical space, of course. But to start off with, Gaurav Bissa joins in to talk about what are his thoughts on the markets today. Gaurav, good morning. Thanks for joining in. Any trades that you're recommending, Gaurav, ahead of the policy on the Bank Nifty or the Nifty?
Good morning. If you look at the setup for the Nifty, you will see that there has been, as in the beginning of the show, it was mentioned that some of the short positions were seen getting built at the higher levels. That is in part true. But if you look at the lower levels, you will see that 10,000 put option still commands the highest concentration. If you compare the kind of OI concentration that is there in 10,000 put option, no other strike is nowhere near this particular level. So there's a possibility that any dip towards 10,050, 10,040 will be met by some amount of buying and can again see a bounce back sort of coming in. It will be volatile ahead of the RBI policy. So what I would suggest is buy 10,300 call option. It has closed around 70, 72. You buy it around 65 or below. The kind of edges is pointing at 15-20 point downside. There's a possibility it may open towards 65 levels, in which case the stop loss would be 50 rupees and the target would be 95. So it will be a gradual move towards 10,200, 10,220. I don't see a great amount of upside coming in. If it sustains 10,240, then we can talk of another 150 point of move coming in. Until unless that does not happen, markets are likely to remain in a range-bound manner.
Okay, so a positive call on Nifty, but you advise buying a call option rather than going long in the futures market. So that's the advice coming from Gaurav Bissa as far as the index is concerned. Now, which stocks you'll be tracking today? Gaurav, any interesting picks there? Would you also again be long on the individual stocks as well?
Well, yes, I have an amalgamation of a long as well as a short call. And among the long one, I would recommend going long on Balkrishna Industries futures. It's given a strong breakout on daily charts. If you look at OI addition, 42% OI addition has happened in the last 2 days or 2 or 3 days, and 5% jump has been seen. So there has been a lot of OI addition that we have seen, but the price is yet to see the follow-up. And as I mentioned, has given a breakout on daily charts as well. It can be a good, it's a good cocktail of data as well as the breakout levels. One can have a stop loss of 2180, buy the futures for targets of 2260 to 2300. Second would be sell on Tata Steel. At higher levels, we are seeing unwinding happening, and it has only augmented once it breached the 690 mark. If you look at the option chain, 700 call option and the put option combined, that is the 700 straddle, has the highest Y concentration. So as long as it's trading below these levels, it would be a sell on rise for the name. One can have a stop loss of 688 and sell Tata Steel futures for target of 616.
Okay. Since you are going short on Tata Steel, would you also be going short on Vedanta and Hindalco?
Hindalco, for some reason, has been finding a lot of resilience at around 235. So I would be selling, but only below 235, in which case the stop loss would be 238 and targets of 228 can be seen as a strong support seen at around those levels. So it's not going to be a basket sort of selling that we can see in the metal names. There are certain names that can see some amount of vulnerability. Hindalco, yesterday we gave a technical buy recommendation. So it has been finding good support at 235. Trading between 235 to 45 zone. So let the range break, then it would be prudent to take a short call. As far as Vedanta goes, that is one name that is looking a little bit weak. One can sell Vedanta below the levels of 285, because these are the levels from where we have seen some sort of short covering coming in. Below 285, it can head towards 278 to 275 levels. 288 can be the stop loss and sell below 285.
Okay, so that's the call coming in on metal stocks. The way metal has really declined in commodities market, this sector is likely to remain in focus and will remain under pressure, looks like. Well, moving on to our special segment, Bloomberg Edge, where Jayesh Khilnani tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock. Jayesh, which stock are you looking at today?
Morning, Pradeep. I'm looking at Bharti Airtel and using the proprietary indicator by Bloomberg called as Fear and Greed, which has actually given a buy signal on the charts of Bharti Airtel as per yesterday's close. Now, let's first have a look at how the fear and greed needs to be decoded. It's a spread of two weighted moving averages, which use the concept of true range, and it oscillates on a zero baseline, and hence very easy to interpret. It either has a positive value or a negative value, and is denoted by those respective colors. Therefore, so you buy when fear turns into greed, that is red to green is buy signal, and the other way around, when the indicator turns from green to red, you go out and sell, and that is exactly what has happened on the chart of Bharti Airtel. Now, as of yesterday, you can see that this green bar, the last one that you can see, that has turned positive, and hence it has generated a buy signal on Bharti Airtel. But Pradeep, it's important to note that in the last half an hour or so, that SGX Nifty has actually slipped more than 30 points. So wait and watch what actually happens to the market. If there is strength like we saw yesterday, which the market actually recovered from the day's low, only then you would actually hold this true and then go out and buy Bharti Airtel.
So any long trade, if you want to take today, you'll have an eye on Nifty, of course, because it's trying to kind of hold around 10,100 levels. In fact, for a while, SGX slipped below that mark, but has recovered since then, currently at 10,106, 10,107. Jayesh, before we let you go, have you back tested this indicator for Bharti?
Yes, Pradeep, 25% is the hit rate that Fear and Greed has on Bharti Airtel.
Well, thanks a lot. So Bharti Airtel is a stock where there is a contrary, I would say, a buy signal coming out in an otherwise weak market. Although yesterday we did see some amount of buying interest emerging from lower levels, and market in fact remained range bound and closed somewhere in between the day's range. So there is no clear signal if you look at the yesterday's close and then try to get any indications for today. Although early morning signals today are definitely weak. Nikkei is down now 200 points, and look at the Hang Seng. Just cracked by around 450 points or so. So Asian markets are going from bad to worse. So if you are really looking at the Hang Seng down 360 points at this point of time, the signal is definitely not good. But let's move on to IPO market now. It's the 6th IPO offering from Future Group, and this time its logistics arm, Future Supply Chain Solutions, is looking to raise 650 crore rupees from the primary market. Somit Sarkar is standing by with all that you need to know about this company and its public issue. Somit, the promoters are looking to make quite a bit of money through this offer. There seems to be no fresh issue really.
Yeah, it's a complete offer for sale, and it's not only the promoter but the private investor also. So the company is looking to raise as much as 650 crore rupees at a price band of 660 to 664. At the upper end of the price band, they are valuing the company at around close to 2,700 crore rupees. Now, the entire issue is an offer for sale where the promoter Future Enterprise Limited will be selling shares worth around 130 crore rupees and will make around 28 times its investment in the company, that is Future Supply, while the private investor, that is Griffin Partners, will make around 2 times its investment by selling shares worth 520 crore rupees. Now, Future Supply is one of the largest third-party logistic company following an asset-light business model. Now, it has presence over 3 segments, that is contract, express and temperature control. Now, over the years, that is from FY15 to the first half of financial year 2018, the company has increased its presence in the contract logistics segment, where it provides warehousing, distribution and other value-added services. Now, in the express business segment, they provide door-to-door delivery service, and when it comes to temperature control, the business was started in 2016 and is still loss-making on EBITDA front. Now, if you see, the company generates majority of its revenue from future group companies. Now, in first half of financial year 2018, it generated around 70% of its revenue from future group companies as compared to 46.5% in financial year 2015. Now, when it comes to peer comparison, Future Supply Chain's revenue grew at a compounded annual growth rate of 17% over FY15 to FY17, which is at par when compared to Mahindra Logistics and higher when compared to TCI Express. Now, the company's margins for the first half of financial year 2018, I'm talking about EBITDA margins, was the highest at 15.7% when compared to peers. Now, when it comes to the net profit, it grew at a CAGR of 36%, which is highest when compared to Mahindra Logistics and TCI Express. Now, this is because in the financial year 2017, the company's net profit was higher because of lower tax outgo and higher other income. On the return ratio side, if you see, the company's return on equity and return on asset is better when compared to Mahindra Logistics, but not as good as that of TCI Express. And though the company follows an asset-light business model, its return on capital employed was lowest at 14.5% when compared to peers like Mahindra Logistics and TCI Express. On valuation side, on the basis of price to book, price to earnings and EV to EBITDA, the company's pricing is not that expensive, but when it comes to market capitalization to sales, it is valued at around 3.7 times, which is very expensive when compared to Mahindra Logistics and TCI Express. Finally, the brokerage verdict. Now, brokerages have a mixed view on this IPO, as Choice and Angel are saying that the pricing does not leave any room for upside, while Emkay and Reliance Securities Research are saying that you should subscribe to this IPO with a long-term view and not for listing gains, while GAPL has a subscribe rating on this IPO on the back of company's unique business model and strong growth metrics.
Thanks a lot for that, Somit. We will watch out for this one. Gaurang, have you guys come out with any notes here? Future Supply, and if not, related companies in this pocket?
Well, Neeraj, we have in fact yesterday come out with a subscribe recommendation in the IPO note that we have released. And we believe that long term there is going to be tremendous amount of positivities emerging. And with other recommendation as far as the logistics sector is concerned, we have a buy coverage on Transport Corporation of India, Container Corporation, Blue Dart, to name a few.
So these are the companies where you are actually positive. But what do you think would be the impact on Future Enterprises? That would be interesting to see actually. 49.10 was the closing price yesterday, and because all the cash is moving to that company, we'll also keep an eye on that stock maybe.
Well, okay. So that's interesting. Gaurang, any thoughts here?
I'm sorry, which one?
Future Enterprises, the promoter who is actually getting all the cash.
Well, Future Enterprises, Pradeep, we don't have any coverage, so it will be difficult for me to comment on.
Okay. Some other interesting names include Sugar, Pradeep, and interesting comments if indeed the stock limits get lifted off. What happens to those counters? Maybe a bit of a buying that comes in from those stocks. And you know, we saw some signs of that yesterday, visible buying that was seen in the sugar counters. Delivery percentage is not too bad either. Let's see if that continues. Gaurang, before we thank you, a thought on sugar companies, and if indeed the stock limits are removed, if indeed import duty is raised, can it fundamentally make the space a lot more attractive than what it has been for the past 3 or 4 months?
Well, Neeraj, honestly speaking, we only had a coverage on one particular stock in this sector, and that is Balram Chini. And my worry is more from the policy changes, government regulations, and diktats. And there is absolutely no denying that these stocks in the last year and a half have rallied 100, 200, 300%. But Balrampur Chini, and that too, the levels at where Balrampur Chini is trading, it's very close to our target price. So if you have any old investments, you can continue to hold on. But new investment, I think you should either wait for a correction or preferably avoid given the kind of run-up that's.
Okay. Leave it at that, Gaurang. Thanks so much for taking the time out and joining us and giving us that perspective. While in moments from now, Deven Choksey at KRChoksey Securities will also join us. If I am told he is joining us. Deven, we're just about 30 seconds away from pre-open. But just a quick thought here. Sugar, the stocks rallied quite strongly yesterday. Talk of stock limits being off very, very soon. Any thoughts here?
Yeah, good morning. Not immediately that I think we would like to consider the complete basket of sugar, but couple of companies within the sugar baskets, and one of them would be EID. EID looks, I think, pretty convincing, interesting, from all point of view, including from the refining point of view. I could elaborate, I think, but for the want of time, I think I'm just cutting it short. EID looks, I think, interesting.
And we will talk more about this as well. It's an interesting one. We will talk more about this, Deven, in just moments from now. But you're right. Pre-open rates about to kick in. Remember, as Pradeep said, Asia has weakened a bit. The SGX Nifty 2 has cracked a bit more from what it was trading at. So watch out for how the markets start off. We will start off weak. That's not a surprise. That's not really a point of contention. The question mark is how weak can we get at the start of the trading day today? Because just yesterday in the dying moments of trade, we actually exhibited some strength. Certainly doesn't look like we will continue with that strength. The question mark is the extent of the fall. For now, it's a sedate start to the pre-open rates. Let's see if these rates change a bit. Bring up Reliance Industries and bring up the HDFC twins. There have been interesting moves in all of those, but let's see if the large weights or the heavy weights really manage to rally a little bit in the session today. HDFC marginally higher, HDFC Bank unchanged, Reliance Industries lying flat. So no, the pre-open rates are showing fairly dominant trades. SBI and the PSU pack had a sharp move on the upside in trade yesterday. SBI, PNB, Can Bank, all of these ended in the green. At the start of the pre-open session, doesn't look like they are making any meaningful moves. Now let's give these rates a chance to settle down, though I dare say a bit more red than green on the screen. Just want to mark Dish TV as one stock before I hand it over to Pradeep, and let's see if there's a reaction to those results. Starting off lower, let's see if there's some bottom buying. Brokerages seem to be unperturbed with what's happened in this quarter.
Yeah, and if you look at some more stocks, Adani Enterprises is down around 4%, JSPL is down around 3%, ICICI Prudential is another key loser. You also have some pressure on realty stocks like Prestige Estates and Oberoi Realty. Future Retail is down around 3%, and Imami, interestingly, it's not a very active stock actually, but today in early morning it's down around 2%. On the positive side, you have Bharat Financials, which is likely to open higher by around 1.5%. Coromandel, CESC, Reliance Power, and Balakrishna Industries. These are some stocks which might open higher. Adani has now slipped by around 7%. Let's see if these pre-open trends will really sustain. But as of now, there is a lot of weakness at this counter. Also, Biocon slipping now, down around 2%.
Before we move on with some of the other stocks and get in Deven Choksey, let's get in Agam Vakil, who joins us with the big brokerage call of the day.
Well, thanks, Neeraj. I have Morgan Stanley on Aditya Birla Capital this morning, where they have initiated a coverage on the stock with an equal weight rating and a price target of around 185, which is a tad below its current market price. They expect steady rise in profitability in lending as well as its AMC business, but ABCL has a good exposure in terms of rising financialization in India, and because of that, they're putting a CAGR of 33% for the NBFC and as far as 35% for that AMC business over the span of FY17 through 20. However, while they are very positive in terms of its long-term prospects, they also say that in the near term, its valuations seem full, and that's the reason why they have given it an equal rating with a price target of 185.
Interesting. Remember, since listing, this stock much spoken about, much hyped, and much that people said that it's a great company to buy in. I don't think Aditya Birla Capital has really moved too much. It's been very, very dormant. Bring up the 3-month chart if we can of Aditya Birla Capital. I doubt it's gone above 200 in at least last memory. The last 1 month, it's just stayed steadfastly sub that 200 mark. And the last 3-month chart as well, I don't think will look too dramatically different. There on your screen, 207 is the cap. It's just not gone above that level for the last 2 or 3 months. Deven Choksey will talk about EID parry too, but just a thought on Aditya Birla Capital. I mean, it's in the right space. Is it fully valued? It's just not seeing any kind of buying.
Yeah, Neeraj, I think the stock appears to be, I think, on a tighter valuation side, I must say. I think it's not a easy valuation where you can probably confidently go and buy the stock immediately. Having said that, I think you already have a good amount of verticals within the business, and that's where I think one feels a little bit more optimistic and confident too. Insurance vertical, you have got the finance vertical, the AMC vertical. Each of these verticals that you have, I think they have the ability to produce larger amount of gains. But in the near future, as I see it, I think the upside in the stock price could be possibly limited because of the valuation, which remains quite capped, quite tight it is at this point of time. So a good story, but at the same time, we'll have to wait for some kind of a correction, maybe price correction or a time correction to add this stock into the portfolio.
Either price correction or time correction before you add this stock to your portfolio. That's the call coming in. Deven, what is your advice on metal stocks? The way in commodity markets, we are seeing all the metals tumbling down. If somebody was holding on to these stocks, say steel or base metal companies, is it time to exit at least tactically?
See, Pradeep, the long-term view on the metal remains quite bullish. I think we remain distinctly bullish about metal for taking a view of next 2 to 3 years, at least from now. The cycle has already turned upwards, and no doubt in mind that I think this cycle will continue for another 3 years. That is very clearly given. Reasons are already attached. I think I could elaborate, but more importantly, I think they are right in favor of, I think, higher production. They are right in favor of lower cost. They are right in favor of, I think, having the rationalization on the pricing and the cost structure. So obviously, I think this particular space is looking relatively more convincing and interesting from now on. Having said that, once again, I think the issue is pertaining to the stock prices. If you find that the companies are running away ahead of times in building the valuation, quite possible that in the commodity space, for whatever the reasons, I think in the near future that you face some amount of the cut in the commodity prices would result into fall into the stock prices that we are having currently. And that is where I think one will have to remain a little bit more careful about adding this particular stock in portfolio. Cyclical trend is no doubt in favor. Buying at a higher valuation would be slightly painful. So I think might as well we'll have to wait, I think, to buy into this portfolio at a little lower price or corrected price.
Okay, what else? As the pre-open rates look to settle down, we'll just bring up the Nifty and see what it is showing in the pre-open session. About, well, just 0.25%, surprising. Maybe it will react a bit more. Look at the sugar names though. Sri Renuka Sugars is up about 3%, Bajaj Hindustan 2.5%, Balrampur Chini about 1.5%. It's looking fairly interesting for the sugar pack. Deven, we were talking to you about the sugar names. You were mentioning EID parry.
Yeah, the company looks interesting. I think in the current year, you are likely to see the higher amount of sugar production coming up in the country. Generally, except some pockets, I think the cane availability has been good. So that is giving an assurance that I think the amount of production in the sugar would probably, I think, accelerate. Now, having said that, I think in EID's case particularly, I think they have had a situation wherein I think they had relatively smaller availability of, I think, the sugar cane, and that probably affected them to a certain extent. However, they have got the refinery and they have got the raw sugar importability, so they would probably in a better position to manage the situation. We believe that I think it is this refinery which is basically being going to be a catalyst for the issue for EID parry, and that's where I think we believe that this company probably holds a better chance comparatively, given the size, given the capacity, and given the ability to import the raw sugar and process it, I think this is relatively a better story in happening. Plus, the balance sheet is quite disciplined balance sheet compared to many other Uttar Pradesh-based sugar companies. So, from that perspective, I think you feel a little more confident in this space.
Okay, so that's the call coming in here on EID Parry. Well, interestingly, two stocks which were kind of in a downtrend, Lupin and 5 Paisa Capital. Interestingly, promoters have bought into both these stocks. Look at the reaction. Lupin hasn't really moved, but 5 Paisa Capital has hit the 5% upper circuit on that news. After significant decline in both these stocks, 5 Paisa in fact got relisted. I think it was relisted around 250 if I'm not wrong, and from there it has been falling. Deven, do you have a view on either of these two stocks?
No, Pradeep, I think both of them, I think probably not. Definitely Lupin is also not under coverage, and 5 Paisa certainly not under coverage either.
Well, maybe Gaurav, Bissa has a thought on pharma and Lupin. Gaurav, any thoughts here? Lupin in particular?
Well, Lupin, I do track it. It was looking good around 825.30, but here it's given a small sort of breakdown, and I would avoid it for the time being. If somebody who wants to buy, I think the safer levels would be to buy only about 835, 840 with the struggles of 825, targets of 880. Till the time it is trading below 815, 810, I would avoid it. There's a support that one can see at around 790 kind of levels. I would not be short at these levels, but yes, the buying should be done only above 835, 840.
Gaurav, Navneet was talking about brisk activity in Balkrishna Industries yesterday on the FNO side. It's starting off well today too, about 1.5% higher. Any thoughts here?
Balkrishna has given us very strong data, sort of, as I said, 42% OI addition in last 2 days and a breakout on daily charts. I think any reason if you get it around 22.05 in spot levels, you can again latch on it, and on the upside, even 2300 in 2 days can become quite possible.
Okay, so if you get it, I think Gaurav Bissa is saying that if you get it at slightly lower levels, maybe 2205 or thereabouts, is when, on the futures side by the way, is when you can go out and buy into Balkrishna Industries. Do watch out for this one. Couple of other stocks which are doing well include a PNB Housing Finance, so that is likely to start off well too in trade. However, just minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. Watch out for metal stocks on the back of the sell-off in the commodity prices. Both LME and the Chinese markets are showing a sharp downtick. The Nifty Metal Index starting off slightly lower.
While Adore Welding, Arcia, Centrum Electronics, Kridhan Infra and Pokarna are going to report their numbers today.
Windsor Machines, a stock on a roll, reports a strong quarter and starts off higher today. Dish TV, Lux Industries, Manali Petrochem and the Bike Hospitality are amongst companies that have come out with a weak set of numbers.
Shilpa Medicare receives 10 observations from US FDA under Form 483 for its Telangana plant. So stock is likely to open weak. It's down 4.5% actually.
On the primary markets, Shalby IPO subscribed 0.2 times on day one, while Future Supply Chain Solutions IPO kickstarts today.
And promoter Nirmal Jain buys 1,25,000 shares in 5 Paisa Capital. This stock has had 5% upper circuit in pre-open.
Well, interesting. After a series of down circuits, 5 Paisa Capital might start off on a good note. So interesting. Do watch out for that. Deven, Choksey, we've asked you a number of stocks from our end. Anything that you believe could be a stock that people can either invest into currently or keep it on the radar to invest at lower levels?
So, Neeraj, I think our preference is going to, I think, couple of companies, and I don't mind sharing names too, because we have been regularly adding that into the portfolio at every fall or correction. And that is, one would be the SBI, and second would be the life insurance business of HDFC Life as well as SBI Life. We believe that I think this is a space where you have a larger growth opportunity available, both from the point of view of companies producing better results, at the same time stock market performance on the stock price I think could do much better. SBI in particular, we believe that against I think 1,60,70,000 crores worth of NPA books, this is a largest bank I think with the NPA, and the NPA process is now I think the sale of assets I think in the NPA space is now happening. and this process has started moving. We believe that, say for example, likes of SR Steel, where earlier the expectations were that I think it would have a haircut of around 30 to 40% on settlement side. Our understanding is that I think it could be well limited to 20 to 22% or 23% around that level. I think the haircut would take place. So on one side you are recovering the money, on other side I think your haircut is less. So to a greater extent I think it gives you a double whammy or the positive effect into the books. Assuming that in next 4 years time you end up recovering your non-performing asset related problems I think are getting solved, and you have an outstanding book of around 180, out of which I think, assuming that I think you end up recovering 140-50, I guess I think you are talking about some 35-40,000 crores worth of recovery happening on a yearly basis in next 3 to 4 years time, and that could possibly strengthen the balance sheet. Already we are seeing the growth happening because of the large deposit or bulk deposit I think borrowed at a higher cost, and I think going to be lent at a little lower margin but in a bulk category. So we find I think this is an opportunity for investment purpose.
Okay, 30 seconds to market open. Deven, Choksey, take a moment to thank you and sharing with us your views. Really appreciate this. Before we hit market open though, Gaurav, Bissa, very quickly, 10 seconds. One top stock that you would bet on today.
I would recommend buying McDowell. The futures has closed on 34.15, 34.20. Stop loss of 33.85, 33.90. On the upside, targets of 3500 can be seen.
Yeah, United Spirits is the one that Gaurav Bissa is talking about. That is his top call for the day today, not McDowell Holdings. Keep that in mind. United Spirits is what people should watch out for. Okay, this is what the market is doing this Wednesday morning ahead of policy. Must say, we're faring a bit better than what the rest of the Asian bourses seem to be pointing towards. The Sensex hardly showing any fall. The Nifty Bank, which has been more resilient the last 2 or 3 sessions, is also starting off just about 1/3% higher. But let's wait. This could be deceptive. Let's wait and watch if indeed this worsens. The market breadth and pull up what's happening to the mid-cap end of the market too. About 1/3%. The small caps aren't falling. It's not that bad a start. I would believe red is dominating the heat map. Let's get the heat map up. There would be more red than green, I would presume. Yes. Commodities naturally starting off on a weak note. Look at this section. You don't need to look somewhere else. Just look at this section. And you will see Vedanta, Hindalco, Tata Steel, a bit of a sentimental impact there. Any which ways in commodities have fallen, and it is this basket of stocks, the commodity space, which has really fallen off. Must say Aisha too continuing its fall. Remember yesterday the auto names came off very, very rapidly. Almost all the auto names were in the red, and it's not different in today's session too. Any gainers? No, not so much. Just a bit of buying that we're seeing in some of the defensives, quite frankly. If you look at it, Sun Pharma, Infosys, Techem, Reddy's, IndusInd Bank, TCS. So very, very muted day of trade. Must say no aggression out here in the large cap space for sure. But specific mid caps that could be in focus. I just want to mark 2 or 3 names, quite frankly, which could be in focus. Dish TV, it's a weak Q2. Analysts though have been positive. The stock starting off about 2.5 to 3% high, lower in trade. An okay start for Dish TV. A couple of other stocks, the FI limit height in Bharat Financial, but it's not helping the stock at all. So lying very, very dormant in trade today. What could be active though are these names. So 5 Paisa is just reverse courses completely. Wow. It started off well, but somehow, no, these rates seem to be a bit off. Anyways, let's just remove this. Let's just bring up the next stock, and that's Shilpa Medicare. FDA roadblock coming in, and that stock is starting off 5% lower. But Pradeep, 5 Paisa Capital starting off well.
Yeah, so that is one interesting stock where in pre-open we saw higher levels, and I think it's up around 5%. So there is some technical issue maybe with the rate there. 206.45 is the price, right? Okay, so this is the correct price. This stock is actually positive. If you look at some more stocks, Shilpa Medicare we talked about. Also look at Hathway Cable, Bhansali Engineering, Minda Industries. These are some more losers in the mid-cap space. Also, you have Tube Investment, which has been volatile, though it recovered quite a bit. Some of the active mid-caps like Shankara Buildcon have come under pressure this morning, and so is Adani Enterprises. But look at, whole host of metal names. You have Hindustan Copper, Hindustan Zinc, Nalco, JSW Steel, JSPL. So entire metal pack is down, and that is because of the weakness in commodities markets for sure. On the positive side, if you look at the mid-cap space, you have fertilizer and sugar. These two pockets doing quite well, and maybe a few logistics stocks as well. So you have National Fertilizer up around 3.5%. RCF also moving up. I also saw some more fertilizer names doing well, like Coromandel. On the other hand, you also have Apex Frozen Food that continues to hit the highest upper circuit. Aegis Logistics is up by around 2.5–3% in today's trade as well. Mid-cap cement, by the way, JK Cement is doing well in today's trade. Jan Irrigation is another active mid-cap stock which has opened higher. So there are select names in mid-cap space which are doing well, and Nifty is also trying to find some support. Around 10,080 was the lows, trying to recover from those levels. Hasn't really hit yesterday's lower level at around 10,070.
Hasn't. Just before we thank Gaurav Bissa, and if we do have Gaurav still with us, okay, I think we lost Gaurav Bissa, but we got his thoughts. Remember, United Spirits was the stock that Gaurav Bissa was saying is something that he would look to buy. Just get in United Spirits once and just see what it is doing in the session today. Lying flat, but remember, these stocks have been active. However, get in our special guest for the morning, and on the sidelines of the Emkay Connect conference, and we'll talk about the conference in a bit with him as well. Dhananjay Sinha, Head of Research, Economist and Strategist at Emkay Global, joins us right now on the show. Dhananjay, good morning. Thanks so much for joining in. We'll talk about the conference in a bit as well, Dhananjay, but just a quick thought on what the markets seem to be doing. We are close in technical parlance to some key moving averages. Commodities have weakened and the Asian bourses are looking soft too. What's the near-term call on the markets?
So I think as far as the market is concerned, I think there has been quite a bit of buoyancy, especially in the mid-cap space. There has been a lot of participation by mutual funds and retail investors. So I think that had created a backdrop of buoyancy. But I think there is a sort of plateauing of that sentiment. I think there is some correction that is possible in the context that 2-3 things that are very important from Indian market standpoint. One is the Gujarat election that is coming up in the next week or so. I think the outcome of that is very critical to be watched, and I think some of the opinion polls are showing that the margin for BJP would be somewhat lesser. So I think that is something that is weighing on the markets. I think from a global standpoint, I think the correction in the commodity prices that had led up the stocks, especially in the commodity sensitive sector from a positive standpoint, and also you have the monetary policy that will be announced today. I think the sentiment is veering more towards neutrality, and expectation of rate cuts is actually flagging off. And I think the fourth thing is the concern on the fiscal management, especially as a fallout of GST. There is some concern with respect to shortfall as far as revenue generation for the government is concerned. And I think there has been a reduction in the excise duty for the petroleum product prices, so that's also adding up. So I think the fiscal concern is also adding up to the sentiment. So overall, if you put all these things together, it does look like there is a fatigue with the momentum that was happening earlier on. There is a possibility of correction in the near term, hence.
So you don't really expect any action in the credit policy today. What is that you will be watching out for in the commentary?
So I think very critically, we will see whether the RBI moves more towards a more hawkish stance within the neutral view that it has, hawkish view within the neutral stance that it has. So that is something that we'll look at. What is the trajectory with respect to inflation that it is talking about in the context that you have a fiscal expansion that will be that is ensuing, and the effects of GST dislocation and demonetization may be fading out. So what does that do to the demand? So that context is very critical, especially in the context where global growth is actually moving up. Domestic GDP growth also has moved up to 6.3% in the second quarter after a dismal 5.7% in the previous quarter. So I think there is some positivity with respect to demand and some uptick with respect to inflation. And I think third thing, most critically, will be the possibility of increase in current account deficit. So if you look at the first half of the year, it is likely that the first half will show us a current account deficit of about 1.7 to 1.8% of the GDP. So there is a widening of the current account deficit that's also happening. So all these things will be very clearly watched with respect to the monetary policy today.
What about banks, Dhananjay? I mean, if we purely look at it from a trade perspective, there is a bit of strength that the banks have exhibited in the last 3 or 4 sessions, and there are some tailwinds for PSU banks as well. Never mind what the privates are doing. What are your thoughts?
Yeah, I think what is happening is that the yield curve is actually steepened. So if you look at 10-year bonds, GSEC yield has actually gone up from 640 to 705 or something. So I think what is happening is that, that had actually resulted in correction in the PSU banking space, especially after the rally or exuberance that we saw post the announcement of the recapitalization plan. So there was a correction after that as the yield curve actually steepened. I think currently whatever you see in the market maybe is a context where a fall in global commodity prices is seen to be sort of neutralizing that rise in yields, and possibly the expectation on rising yields is actually priced in within the PSU banking space, and hence I think as things are priced in post-event, that is the monetary policy, there can be some pickup as far as PSU banks stock prices are concerned. So these are very sentimental elements that will last for a few days, and these are all trading views, but definitely we believe that over a longer term the yields are on the higher side. Our expectation is that 10-year yield will go further as the economy does better, and as credit growth improves, all those things will translate into high yields, and hence this whole trade that you will see in the near term with respect to PSU banks will be more of a short-term nature. Over a longer period of time, our view is that the private lenders will continue to gain market share in the upturn that we are seeing with respect to the credit growth. We are expecting that by year-end FY18, you will be somewhere around 12 to 13% as far as overall systemic credit growth is concerned, and further up in the following year. And this whole upturn will be largely captured by the private lenders who are well capitalized. PSU banks will find their feet. They will still need to raise money. They are looking for this whole recapitalization plan to roll out over the next 1.5 years. So I think there is a sort of lag that we are seeing with respect to PSU banks in terms of their potential to grow more rapidly than the system. So I think in the upturn that we are looking at in terms of business, we believe that private lenders will continue to lead.
So what you believe in is that bond yields will move up because economy is going to do better going forward. Credit will pick up. In that case, which sectors do you think will actually be doing well, where there could be an opportunity for the investors to buy into those stocks?
So I think what we are looking at this juncture, there is a valuation concern, and I think if there are sort of corrections, then we'll really need to look at stocks and sectors where we'll need to be in. So my bias has clearly been in favor of consumer stocks, FMCG, durables, discretionary spend. So autos is another pack that we've been liking, within that two-wheelers, passenger vehicles, especially those that are oriented towards rural economy. So that's one space. I think we have talked about the banking sector. We are clearly in favor of the private lenders. Even if we are looking at corporate lenders, we will be looking at private lenders such as ICICI Bank, Axis Bank. Otherwise, we continue to favor the retail lenders such as HDFC Bank, IndusInd Bank. All these people will do better. I think within the NBFC space, we believe that the HFCs, housing finance companies, will be somewhat more vulnerable given the context that they will see a margin pressure coming from a rising cost of funds. and the competition on the mortgage side is still going to be pretty strong. So I think the compression in margins is clearly what we see. So we prefer the NBFCs who are more into retail lending, where the asset liability management is better. Both in terms of the liability and asset side, they have shorter duration. So I think they will do better. And agri inputs, including agrochemicals, fertilizer, and tractors, for instance. Tractor has been my favorite space for quite some time. So I think this is a whole set of sectors that we like. So in essence, what we are looking at is a scenario where you have fiscal reflation that we've been talking about, because the government will be more inclined towards doing better and increasing the disposable income at the hands of individuals. And I think seventh pay commission at state levels and local levels will also need to be included in terms of the demand scenario. So I think the uptrend that upcycle that I'm looking at is largely going to be more consumer driven and stocks and sectors that are dependent on this deflationary impulse. Okay. From a global standpoint, I think I'm still positive on the commodity prices. So those are the sector pro commodity sectors will actually do better.
Okay, we'll have this chat on some other day about commodities as well. But Dhananjay, need to talk about the conference as well. Ears to the ground. Oh, interesting time to have a conference like this. We were just talking about a report on cement prices coming off. We were talking to a couple of real estate suppliers who are saying, or plywood companies who are saying that things haven't really picked up. What's the nature of this conference? What's the conversation that we can expect from here?
So I think the areas that we are trying to cover here are agrochemical, automobile, building materials, cement, and consumer staples. So the overall context that we are looking at is, if you look at the agrochemical space, we want to look at how the Rabi season is progressing post the GST, whether the dealers have started to restock or not. We got a sense that the restocking did not take place as much after the implementation of GST. Is that momentum picking up or not? Is something that we try to look at, and hence what is the implication for the industry and the stocks. And then we look at the automobile sector. Here the numbers have been pretty robust, especially for two-wheelers and passenger cars. We have a upcycle also coming for MHCV space. How are the dealers looking at that? What are the company-specific strategy people have to capture the rural demand, for instance? So some of the companies have talked about better improvement in the rural demand. That is something that we'll talk about. The other aspect to look at is building material. As you rightly said, people are somewhat. This sector has undergone a sort of a slowdown for the last 2-3 years. There were expectations that post the GST there will be a shift from unorganized to organized. Many of the players that we have met have also said that shift hasn't happened so much as of now. So it will take time. I think there are further settlements with respect to GST implementation that needs to happen before things turn around. Cement sector, there are mixed regulatory issues out here. In some states there have been some easing of ban on sand mining. In others there has been some restriction with respect to pet coke usage. So overall the industry hasn't been seeing a very robust demand. The pricing power has been weak. And a regulatory environment which is sort of mixed. So we'll need to really look at what the dealers are telling, what is on-ground reality with respect to what's happening to real estate. Is there institutional buying that is happening from a government standpoint or not? So that is another thing that we'll look at. And with respect to consumer staples, we have seen some of the companies talking about improvement in the rural demand. There's a pickup that they are talking about. So the dealers will actually tell us what the companies are implementing as far as product strategy is concerned, segment strategy, and also how the consumer behavior is changing on ground. So I think that's the sum and substance of things that we are looking out in this conference today.
Well, have a good one, Dhananjay, and look forward to some interesting conversations out of this conference as well. Thanks for joining us today to give us a lowdown on markets and what the conference is about. We'll see you during the course of the day as well. For now, though, just before we slip into a break, the markets, Pradeep, looking well, not looking that bad. We would have anticipated maybe further cuts in light of what's happening in Asia, but just about 0.25%. So looking okay. The Sensex, in fact, lying very, very flat.
Yeah, so in fact, we haven't gone to yesterday's low and trying to hold on. Maybe it's also in anticipation of, the policy. So there is a big uncertainty. You can't really short ahead of such an important event. RBI cannot give you any relief, but at least, they can soften their talks, and that could be enough. So I think traders are cautious ahead of this most important event.
Yeah, let's wait and watch. For now, though, we'll talk about the event on the other side. The monetary policy expectations with Manish Wadhawan of HSBC India. He joins us. And then a bit later on, a stock which stays on an upper circuit for the last n number of days that I remember. Apex Frozen Foods. We speak with the ED of the company.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Welcome back. You're watching Indian Open. Monetary policy decision coming up at 2:30 this afternoon. I'd call it a big event, except that most are expecting that it will be a bit of a non-event. Nevertheless, lots behind that decision to discuss, even if the monetary policy chooses to keep interest rates unchanged. Joining us to speak about some of that is Manish Wadhawan, MD and Head of Rates at HSBC India. Manish, good morning. Great to have you here today on Bloomberg Quint. Manish, there's a small constituency which is continuing to argue that a rate cut, at least one last rate cut in this cycle, is possible. What's your sense? What are the arguments for and against?
I have my doubts about a rate cut today. I think it's going to be quite a neutral policy. I don't want to call it a non-event. It's going to be a very, very important, I would say, event for financial markets, because it will lay down the ground for 2018 expectations in terms of monetary policy settings. I think the key to see is that in the last 2 months over the last policy and where we stand now between October and December, the financial conditions have actually tightened quite a lot in the sense that liquidity has come to a neutral kind of a stage in terms of what we measure as the amount being given to RBI and or maybe lent or borrowed by the banks. It is falling between that 1% plus minus 1%. So, and the bond yields, if you look at it, the yield curves have moved up from 30 to 40 basis points across board, means yields have tightened already. I think that is the key where we are looking at today, that markets have already started factoring in a mild tightness in terms of what RBI has implemented. You might see a neutral policy today, and they might lay down some kind of a glide path for the future. I think the next thing which we are supposed to look at, which will be important for us to look at, is if they revise the growth and the inflation projections again. So I think these would be the factors which we'll have to look at. But the underlying markets yields have already firmed up quite a lot in the last 2 months.
Manish, explain that liquidity situation to us a little bit more. And, we had the Bloomberg Intelligence Banking Liquidity Indicator up on the screen while you were talking. So we have seen considerable tightening, say, over the last few months or so, but we are still in surplus mode. What is the market's expectation that as you get towards January to March, and if the government were to increase borrowings, that liquidity would come to neutral and perhaps even deficit?
Okay, to give a perspective, if we go back 1 year when the demonetization happened, and post that we had a surplus liquidity to the extent of something like 7 to 7.5 trillion INR in the system, which means the banks were lending to RBI. Those numbers have dwindled to something like 40 to 50,000 crores in the last few days. And in the month of December, you might see actually the banking system borrowing from RBI. That means it will completely reverse. That could be temporary because of the advance tax outflows at that point of time. But the point which I'm making is the currency with public, whatever had come in at the post-demonetization phase, the remonetization has completely taken over, and now we are sitting at a neutral level. Second thing is RBI conducted OMOs worth 90,000 crores during this fiscal starting from May, June. I think that's the important message. They might not be talking about it in the policy, but the actions are clearly telling you that they've sucked out that liquidity. That is countering the FX reserves which they built up, but they didn't allow the liquidity to build up. By December, we should have a situation where the banking system could be borrowing around a trillion or lending just a very small kind of an amount. And Jan to March, you would see a phase where liquidity tightens on its own because of other factors. The government balances go up. In the sense, the central government balances start going up because they've already spent nearly full of the fiscal. So the monetary conditions which are measured in terms of LAF, what we say, which the banking system is either borrowing or lending, are already at a neutral stage. There could be a situation where the banking system might need to borrow. That is what I meant, that the liquidity conditions have tightened quite a lot.
So what would the market like to hear from the RBI? I mean, they wouldn't put it in the statement perhaps, but in the press conference later, would you, if there's any commitment that they are not intending to restart OMOs, would that be enough? Would you, want to hear them talk a little bit about the intention to maintain surplus liquidity? What would the market want to hear, Manish?
I think the key thing would be what do they talk about inflation projections and growth projections? Because last policy, they revised the projections in terms of growth to 6.7. Whether that gets revised downwards, because now we have 2 quarters of numbers. So effectively, we need a 7.5% plus for both the next quarters to reach that 6.7. And other thing is the inflation projections are between 4.2 to 4.6 for the whole year. There is a possibility that it might get revised upwards a bit. Why is it happening is because we have seen the commodity prices, the oil prices have gone up something like 30 to 40% in the last 4 or 5 months. It will have the cost push inflation factor, which is hurting somewhere the inflation projections. Also, in addition to that, I use the word, there is a fiscal push in some form of tax cuts, etc., which the government is trying to achieve. So it could actually lead to a higher inflation number, and the growth might be, kept at the similar kind of levels. So if you put all these things together, hoping a rate cut, I don't think so. It actually might show you a glide path that if the inflation goes up beyond this number, they might have to even tighten the monetary policy. The underlying conditions in the global markets is also getting towards tightening. We have seen the first rate hike in Asia from Korea. And if we look at our peers, what is happening in the Asian world, the emerging markets, everywhere the small tightening is happening. In China, the rates have gone up something like 70, 80 basis points in the last 1 year. 2017 has seen uptick in yields of around 70 to 80 basis points. I think putting everything together, what I sense is today is going to be a neutral policy. Today is going to be just accepting that whatever we had projected, we are just chugging along. And no action I expect from RBI today. I think the glide path would start from February or April. In terms of liquidity, I do not expect anything explicit from RBI, whether in form of an OMO or even saying that whether they'll keep a liquidity tight or whatever. They are. I think trying to make the market accept to this fact that we have turned towards a neutral policy, and so accordingly the liquidity is being manipulated here.
Okay. Manish, one more question from me and then I'll turn it over to my colleagues. The steepening of the yield curve, what is it reflecting? Is it reflecting an expectation that perhaps in the second half of 2018 we'll start to see rate hikes? There was a call from Morgan saying that perhaps in the second half of next fiscal, that is, you could see a rate hike, or is it reflecting more the liquidity condition right now?
Combination of both, I would say. It's the demand supply dynamics in the market which plays a role. So, if you look at the central government borrowing numbers, they've been flat for last 3 years now. But the missing point is the state government borrowing has more than doubled in the last 3 years. From a borrowing of around something like 2,25,000 crores, this year they're going to be borrowing something like 4,50,000 crores. So that also pushes up the yields at the longer end because there's a lot of supply. But beyond that, I think what you said, at the moment, if you put 2 and 2 together, if the growth is actually going to pick up from here and we are seeing traction in form of inflation also, then there is a possibility that RBI might have to hike. But I think it's too early to judge those kind of things. Yes, market has, at least in the prices today or in the yield curve today, have taken away a rate cut from the table. So if anything of that sort happens, that will be a real big surprise today if the hint is towards a rate cut. But yes, market has come to a neutral zone, and then wait and watch for the next 3 to 6 months how it pans out.
Manish, I have a quick question here. This is Menaka, and it's a question more from a consumer point of view. You've spoken considerably of the liquidity tightening. Just wondering if at all there is the slimmest chance that that could feed into higher lending rates at all at the retail level?
Minka, I think that might not happen in the next 3 to 6 months. Where I'm coming from is if you look at the credit data at the moment, the credit growth is not more than 6.7 or 7% as per the latest data available. Till the time we see actual genuine demand of funds increasing from, on account of credit from individuals and from the industrial sector, I don't think so that will happen. It's more of an adjustment of repo rate at 6%, and then you accordingly have a government securities curve, a GSEC curve, what we talk about. But lending rates in form of housing finance, etc., at 8.25 or 8.30 or 8.5, I don't see a pressure, anything of that sort, at least for the next 6 months. So that is something which we'll have a cue only in April policy. We'll have an idea. I don't think so we are heading towards any kind of a massive tightening from RBI or anything of that sort. We have come back to some kind of a neutrality in terms of what we saw because of demonetization. That has fully reversed. So that is what, but I don't see any major kind of a reaction in lending rates for the next 3 to 6 months at least.
Okay, and I suppose by the same extension of logic, that would apply to, let's say, deposit rates as well, right? Even though we've seen some very minor hardening in deposit rates for bulk deposits, we would not expect at the retail level for banks to want to be able to attract more money, a higher rate of interest at all.
Now, Menika, very pertinent point what you have raised. We have been debating about it and putting numbers together. An interesting fact comes out. As of today, the credit to deposit ratio is hovering around something like 68%. And if you include other accommodation from the banking system and NBFCs, it is around 75%. If genuinely you believe that growth is going to pick up and the demand for money, demand for credit is going to pick up, then you actually might see some kind of an uptick in deposit rates also, because the deposit creation in the system has been very, very slow. So it's like a chicken and egg situation. If the growth starts picking up from here, you actually might see banks raising deposit rates because you would be needing more deposits to satiate the demand for credit. At the moment, we are sitting on a fence, and deposit rates have been reduced to the extent whatever they could. We have seen the evidence, as you mentioned, the bulk deposit rates from the largest public sector bank were raised by 100 basis points because the interbank liquidity has become tight. So I would actually say we are at a neutral stage. If genuinely growth is going to pick up and credit demand picks up next year as is expected, and the world economies are doing better, the data, whatever we are getting from everywhere, then you actually might see deposit rates also inching up a bit in the next year.
All right, Manish, thanks very much for clarifying that.
Last question from me, Manish. What's the call on the 10-year? How far do you think the yield can go? Building in the possibility of increased borrowings from the government in Jan to March, and also what's the number doing the rounds in the market as to how much the increased borrowing could be?
See, frankly, that's a big black hole era. The reason why I'm saying so is the numbers in terms of the government revenues are still not clear for the last 3 months, means they have not been updated on the CJ website. So we are really not clear about it. How is it going? But if we go by the GST collections, whatever are being published in the press, there might be some kind of an additional borrowing which may not be market disruptive. So I'm not fearing that it's going to be a large extra borrowing coming in the month of January. Those auctions which have been slated for 5,000 crores each could get adjusted by something more by, every auction could become 10,000. So extra borrowing of 20, 25, 30,000 crores, which can be easily absorbed in the system. So that's not a worry. Sorry, I missed your second point. What
the 10-year yield, just wondering how far the 10-year yield can go in your estimates.
Yeah, see the 10-year, yeah, sure. 10-year yield has moved from around 660 levels to 705 now. I don't think we are going to see a massive further upside in yields. For the balance, I think next few months, what we're talking about, we've already readjusted to a new level. We should be hovering around these levels only, unless and until we see a massive surprise on inflation. Otherwise, I think fiscal side, and just to add to one more point, I think the government is getting a lot of collections in form of small savings, which would be used by the central government itself. So that is also one of the reasons that we do not expect that extra government borrowings could be very large. I think 10-year yield will hover around 10-15 basis points from these levels. I don't expect a massive rally to go to 6.5% or a massive sell-off to 7.5%. We are already we've factored in all these new things which are happening in the system, the tightening of liquidity, the higher inflation numbers, and not to forget the growth numbers which are getting under question or lower. The second quarter has also not been too great. So we have to balance it out. I expect quite stable markets for the next few months at least.
All right, let's hope so. It's been a turbulent year, Manish. Thanks so much. Always a pleasure to speak to you. Appreciate you joining us here on this policy conversation. We will, of course, be live at 2:30 with the policy announcement. Neeraj will be here, Emkay will be here. And we'll take it forward. And
you will be at the RBI, and we have a whole host of experts joining us through the course of the afternoon to take the conversation we were having with Manish forward. So make sure you stay tuned for that. But we have next up shrimp.
Yeah, shrimp. But just before we get to that, I just need to mark what's happening in the markets as well. Mind you, precious little if you look at the benchmark index, because that is lying very, very flat. Though keep in mind, 10,067 or 66 is that 100-day moving average, which people refer to very, very strongly the last few days. Should the policy disappoint, from market's perspective disappoint, watch out for those levels individually. For now, I don't think we'll go substantially below that. Probably might be a flat day of trade. The Nifty Bank 2 might be supportive. But watch out for those levels on an intraday basis today. Okay, certain.
Sorry, no, I wanted to put a question to Ira. I would have asked Manish this, but I don't think he looks into bank earnings. But if liquidity is tight, and we've seen such a big reversal in the situation in the last several months, is that not going to impinge? If we are at this point in time, maybe even considering that banks will need to borrow from RBI, will that not at some point in time impinge on margins as well?
If deposit rates start to go higher, yes.
They will,
deposit rates start to go higher as well, yeah, for sure.
Yeah. All right, I think time to move on to shrimp. You may or may not like shrimp, but investors of shrimp exporter Apex Frozen Foods are surely being treated to some lip-smacking returns so far. The stock has surged nearly 5 times since it listed just a short while ago earlier this year. To discuss the reasons behind that surge, we're joined by Karuturi Subrahmanya Chowdary, Executive Director at Apex Frozen Foods. Karuturi, good morning. Thank you very much for joining us this morning. Let me start by asking you, why is it that we're only just discovering in the Indian equity markets the joys of investing in shrimp, and what is it that your company is doing that there seem to be no other worthy competitors, at least in the listed space?
I guess at this point there are very limited players in the listed space with regard to our sector, that is the seafood exports and shrimp exports primarily. So our company, of course, has been focused on producing shrimp at the farm level and processing and exporting them to global markets, but not into the domestic market because the consumption in the domestic industry is not that significant when compared to the global markets.
Sorry, I just wanted to add to that. There's a UN report that suggests that India's shrimp exports are likely to surge by 41%, that India is going to be the standout performer of the year 2017, which is just coming to a close. What are we doing right that's helping us grow that rapidly in the global shrimp market? And can we continue to do that as an industry at least over the next few years to come?
The potential to grow in India is still immense because of the vast availability of land, natural resources, starting with land, as well as water resources. As you know, the huge coastline of India, which is quite significant, and it is only comparable to a country like China, for example, when you look at other aquaculture producing nations around the globe. So with all these advantages with regard to the water resources and along the coastline and also the land availability which is there, this definitely the momentum will be continuing, and the growth that is definitely expected, that it will continue to grow in such a manner. So that advantage will be there with the availability of the natural resources in our country.
You certainly seem to be believing that very strongly because you have some capacity on lease, you are also on a capacity expansion drive. I'm guessing, and please correct me if I'm wrong, that you would believe that demand will stay at these strong levels to drive revenue growth at a rapid pace for Apex over the course of the next 2 to 3 years at least, if not more?
See, with regard to Apex in particular, we do cater primarily to markets like the USA and European Union, which hold around, USA is around 75% and European Union is around 25%. And every year we are increasing our business to the countries of European Union and countries like Canada. But we haven't started doing any business with other Asian countries like China or Vietnam, which are the major importers of shrimp from India at this point, also along with USA. Southeast Asia imports almost 30% of India's shrimp, which we have not yet looked into because we are more focused on high value product markets, which are, and of course, which also have the, the stringent norms in place with regard to USA and European Union. So we foresee that the demand will continue, which will be there. There's no, in fact, we are looking at catering to those high value, value added products market, not just the base products or the ready to cook products, which we have been doing for the past 20 years. Next year, once our new capacity gets commissioned from FY19, we are sure that we will also be able to tap the potential in the value-added products, that is the ready-to-eat products from next year, which we are not really doing anything in that segment. And that the potential of business in the ready-to-eat products is only growing because of the social conditions, and like as you know very well, people are looking at more to consume ready-to-eat products or the meal prepared meals rather than because due to the lack of time or so that we definitely see a large potential in that. And with the markets which we are dealing with, primarily the USA, European Union, Canada, and we look at Middle East in the future, we believe we definitely look at a future very forward, a very good, positive outlook.
Okay, just one quick question, because I don't understand the pricing here. I mean, how does pricing work out? I mean, that's a risk that people believe. What if prices were to fall off? I mean, is that a case for something like that to happen?
Prices are not really, see the prices, of course, like any product, it is demand supply. Now, there are, yes, a lot of issues around the globe, but India has been implementing the right systems under the control of the Coastal Aquaculture Authority with regard to farming, primarily under the Ministry of Agriculture. So India has been practicing the farming in a very under a biosecure norm, which is in fact expanding year on year. So with the conditions improving in India, the supply conditions increase, and the conditions in other countries with their own limited resources, which I mentioned in the beginning of the conversation today, is that the resources available in India are immense. Whether it is the coastline, the land availability, the water resources which are there, are definitely not comparable to any other large those nations which have been producing much more than India in the past.
Okay.
So that way we see that a stable supply is there, continuously going to grow, and the demand is increasing. Every year the demand has been increasing from global markets. As I said, Southeast Asia is now almost buying 30% of India's shrimp, which is also, they are dependent. Even other producing nations are dependent on India's shrimp product.
Right. Karuturi, one final question from my end. If I look at what you've done in half year compared to what you did in FY17, the number looks very, very promising. What's the quantum of revenue growth rate that you forecast for the next 2-3 years? I'm not asking for a 5-year visibility, that might be difficult. And analysts believe your bottom line could actually grow much better, maybe at a CAGR of about 40-45% for the next 3 years. Is that something that is on the anvil?
Well, one, with regard to our company in specific, we have been not just looking at revenue numbers or, as you rightly mentioned, your previous question was about price fluctuations. There can be price drops. So how the company is actually mitigating any such variations is by integrating in in the entire sector, right? Not just processing and export, but also producing at the farm level, also producing the hatchery. And thereby, we are expanding further, vertically integrating in the sector to ensure that we are covered from all the spaces of the sector. So with all these measures being taken, we are confident that we will be able to maintain our present. So even if there are any sort of fluctuations, like similar to your earlier question, there can be a price drop overseas due to a lack of demand at some time or due to huge supply. We have other other segments of our company which will be because if the processing, if the export, the price has come down a little bit, we will be having our farm level cost advantage, which will be supporting the company. That way we are integrating.
Just interrupt you, sir, for one quick last question. We've just got about 40 seconds to go, which is that since you're a 100% exporter, how are you hedging your rupee exposure or dollar exposure to that extent? That's one. And secondly, any adverse circumstances under which your fairly bullish scenario for growth for the industry in your company could change?
Okay, the first question is with regard to foreign exchange. Of course, we do cover our future risks with forward contracts. We always have our future exposure covered. So that way we ensure that we don't get affected or impacted by the rupee appreciation or the dollar depreciation due to various factors around the globe. And with regard to your second question, which is any risks which we see, we are not. We do have issues like disease primarily in the sector, but that is being done in a very controlled manner, as I mentioned earlier, with the biosecurity measures being implemented. We foresee that these biosecure measures in the farming and the hatchery levels, and also the government of India has various steps being taken to enhance aquaculture industry in India, because that is the only alternative for the depleting ocean resources. So we believe it's on a positive note, even though there are negatives like weather conditions or disease, but they are being mitigated by the expansion in area and also the systems being implemented at the farm level.
All right, we're going to leave it there this morning, but thank you very much, Karuturi, Subrahmanya, Chowdary, for joining us. That's Apex Frozen Foods for you. We're entirely out of time. You were watching Indian Open. Up next is the F&O Show.